So let's get started. It's my pleasure to introduce President Patrick Harker from the Federal Reserve Bank of Philadelphia. Prior to joining the Philadelphia Fed, he was the 26th president of the University of Delaware. So I guess that means you took a step up from being the president of the University of Delaware? Okay, good, just checking. And prior to that, he was the dean and the Reliance Professor of Management and Private Enterprise at the Wharton School of the University of Pennsylvania. He is a former White House fellow under President George H.W. Bush in 1991 and was a special assistant to Federal Bureau of Investigations Director William S. Sessions from 1991 to 1992. You probably have some pretty interesting stories from that time, I'm sure. Harker is a board member of both the Chamber of Commerce for Greater Philadelphia and its select Greater Philadelphia Council. He is also a board member at the Science Center in Philadelphia. Harker has a PhD in Civil and Urban Engineering, a Master of Arts in Economics, a Master of Science in Engineering, and a Bachelor of Science in Civil Engineering, all from the University of Pennsylvania. Following his remarks today, President Harker has agreed to take some questions, so please keep in mind those things that you might want to ask him throughout the session. And with that, please join me in welcoming President Harker.
Well, good morning, everyone. Thanks for having me here. It is great to be here and to share space on an agenda with so many experts and voices of authority on community banking issues, including some of my Federal Reserve colleagues. The one problem, though, I have a problem. The one problem is when you speak on day two of a conference like this, you run the risk that your colleagues have already made all the good points, all the most important points. And so you'll just sound repetitive. And so while I hopefully won't sound exactly the same as my colleagues, I'm sure we at least touched on some of the same themes. Because I think if there's one thing that I've found unanimous agreement on, it really is the importance of community banks in America. And so since I am mentioning my colleagues at the Fed and their views, it's probably a good time just to start off and interject with the standard Fed disclaimer. These are my remarks alone and nobody else in the Federal Reserve System. You are my witnesses. I cannot get in trouble now. So with that said, let's get started. As I said, if there is one overarching message to both the conference and to our work within the Federal Reserve, it really is the critical importance of community banks. The Philadelphia Fed is largely a community bank supervisor. So I think we have a front row seat to the effects of community banking throughout our district and how it's been embedded into the DNA of our local economies. And we were particularly proud to note that the winning team in the CSBS case study contest was won by a Pennsylvania school. Congratulations again to Juniata College. And in fact, about 1/3 of the teams this year hailed from Pennsylvania. Come on, everybody else, catch up. The Philly Fed, as you may know, has the smallest geographic district in the system, which in some ways I actually see as a strategic advantage. Within those borders, we have areas that reflect the makeup of the country as a whole: urban, rural, suburban, post-industrial. So I think in this small footprint, we get a very rich sense of the diverse set of economic issues and profiles that our country has. Our size also makes it very easy to spend time out in the district. We don't have to fly around the district. We can just drive to places in the district. So I spend a lot of time out in the district talking to business and community leaders to get a really good sense of what they see day to day, what they see on the ground. And something I've seen again and again is that the places that are doing well are the places with a strong community banking presence. You see this over and over again in community after community. In fact, I'd say that particularly for smaller cities and towns, community banks are absolutely essential for their success. But community banks don't just have a local or regional impact. The insights that we get from our contacts give us context for a remarkably complex national economy. And that actually factors into my own views on monetary policy when we're considering what steps to take for the country as a whole. I often note that the U.S. economy, the biggest and arguably the most complex in the world, is at its core, fundamentally, just a collection of a myriad of microeconomies. It's no one big homogeneous economy. It's made up of communities after communities, localities, neighborhoods, families, businesses of all sizes and shapes. That's what makes up our economy. As contributing businesses and the touchstones of those individual economies, community banks play an absolutely key role in their success. So for that reason, I think it's important that regulators recognize and help mitigate the challenges that community banks face, that you face. Because there are several issues on the horizon, including technological change, demographic pressures, and, of course, regulatory burden. And again, I know I'm repeating the messages you already heard from my colleagues and contemporaries. But given the importance of community banks to the economy and the financial system, I think these remarks are worth repeating. So, I'm being followed on the agenda by a panel on technology's impact on banking. And that's been a central discussion across industries now for some time, of course. Cybersecurity has been a concern for banks of all sizes, but pressure on smaller institutions can intensify when those institutions can't attain the same economies of scale as larger ones. Then there are the advances in fintech and overall changes that come with the continued march of technological disruption. Now, we at the Philly Fed, we have a particular focus on technological advancement and how, for example, machine learning and AI affect the workplace and business decisions, how it's impacting choices people make about education and training, and how, frankly, it is changing the entire economic landscape. And community banks obviously are not immune from these changes. None of us, frankly, are immune from these changes. But I think there are two important things to remember for this sector in particular, for the community banks in particular. First, I think it's worth stepping back a little bit and recognizing that this change is not new, not at all. It's been a constant feature of the industry for decades. It just looks different now, and I would say it feels different now. But the actual change itself is not new. Second, I think those advancements in general amplify the unique importance of community banks. And in fact, I think create opportunities for them. So let's take those issues in turn. Technological change itself is not new. Many of you have been in the industry a long time and have seen this firsthand. Fintech absolutely presents a fundamental change in the way we bank. But let's step back. So did securitization, credit scoring, prepaid cards, ATMs. Now, it is true that those things look pretty quaint when you compare them to today's technology. Just like a Walkman looks virtually antique compared to a streaming app on your phone. But both the Walkman, let's remember, both the Walkman and the ATM were revolutionary at their time. Technology, as it hits the forefront, is always revolutionary. Banking has seen a constant change and churn for the past half century. The difference is that in today's technology, this technology makes delivery systems more advanced than ever before, and it frankly just turbocharges the pace of change. Peer-to-peer lending, for instance, has been going on since humanity first established a barter system. It's just being delivered with a different platform. In my day, when I grew up, it took the form of Frankie borrowing $20 from Johnny at the local bar. Right? I suppose the big difference, though, is that Johnny knew exactly where Frankie lived. And so default rates were significantly lower than in that very low-tech version. But the idea of peer-to-peer lending itself is not new. Overall, however, with fintech, it's the platform that's new. It's not the product or the service. That, of course, presents a business opportunity. It's likely that partnerships between community banks and fintechs are going to increase because the fundamentals of the banking system are not going to change. Whatever mode or method technology provides to deliver those services, they will still need a trusted broker. And I want to emphasize the word trusted, the trusted broker of money. And while bigger institutions may be better positioned to take on the risk of a fintech partnership, the fundamental advantage of community banks is the high level of trust that customers have in you, in them. While community banks will obviously have to do their due diligence when forming partnerships, I'd argue that the deep base of trust is a valuable competitive asset from the fintech perspective. The second technology-based issue is the advances in AI and machine learning, which actually makes the case that the skills and expertise, particular to community banks, are more important now than ever before. Technology, as we all know, is only as smart as the data we input. And particularly in the case of functions like algorithmic lending, the advantage of community banking is even more clear-cut, as we just saw in that video. Community banks know their customer. There's a local understanding that can't be programmed into a one-size-fits-all approach to lending. Now, you heard yesterday from the Bank of Bird and Hand CEO Lori Malley. They're actually an example I use often because it's a perfect case study in local understanding. On paper, the communities they serve wouldn't look creditworthy to most banks. But Bird and Hand knows that when something happens, the community comes together to fix it. When a barn burns down, the community comes together to build a new one. If someone's in danger of missing a scheduled payment, the community pools their resources to make it. That knowledge and understanding of who your customers are is an advantage that can't be replicated by an algorithm. Let me give you one example. So my daughter and son-in-law encountered this when they tried to buy insurance for their first house in South Philadelphia. Now, Philadelphia, like most places, has a lot of different quirks. And we have linguistic quirks like the extra R in the word water. We say water. We actually know how to spell the word eagles very well. We say that a lot during games. That's our cheer. But we also have row houses. Well, most of the East Coast has townhouses or brownstones. Now, in conversation, that's not a big deal. In real estate dealings, it's actually a very different story. So my daughter's first broker, they tried to go to a host of national brokers to get their insurance. But they didn't have row houses listed in their database. They didn't know what a row house was. So they couldn't classify the property. They couldn't understand why the flat roof that they had didn't fit into any of the categories that were on their screen, right, when they're talking to the call service person. After a lot of time spent on this who's on first kind of dialogue with various brokers back and forth, they finally just gave up, walked down to the local agent down the street, who basically said to them, I knew you'd be here eventually. Because that guy knew what a row house was and he knew the neighborhood. That's just one example of how a molehill can turn into a mountain for customers. And this is a real challenge for customers. But the flexibility community banks have to meet these local needs creates, in my view, a loyal base. Because you do know what a row house is. You do know those quirks within your community. And they're really important to your customers. So it's not just that technology highlights the competitive advantage of community banks' local knowledge. I honestly think it creates an opportunity as that specialist insight becomes more and more clear in comparison. So community banks clearly have an advantage with expert local knowledge. They know their customers, and they reflect the needs of the communities they serve. But the demographics of communities across the country are changing, as is the community banking landscape. Since 2009, the number of community banks has declined by about 1/3. Nationwide, bank failures have accounted for about 1/5 of that reduction, while the rest are due to merger and acquisition activity. Now, in the Philadelphia Fed's district, the reduction in community banks has been slightly higher than the national average over that period, 38% for the 3rd district versus 34% nationwide. But the size of the banks in the Philadelphia Fed's district has increased significantly, and significantly more than the national average. The 3rd district's banks' median assets have increased by 89% versus the national average of 57%. Those data point to rates of M&A activity that appear to have strengthened the resulting institutions, and I would argue community banking overall. Over the same decade, we've seen a concurrent change in the asset mix with a significant rise in multifamily loans, 91% overall, though they still represent just 4% of total assets. And while securities have declined significantly, they remain the largest portion of asset mix at 17%. So while there are fewer community banks in the district, they've grown larger and more complex. Demographic changes such as aging and increasingly less mobile populations have already affected community banking as a whole. And look, that's going to continue, meaning that they may have to rethink their business models. That might mean more personal lending and greater small business lending, could mean more commercial real estate lending, or more projects with greater potential risk, but of course also greater potential reward. From the regulatory and supervisory perspective, I think it's important to watch for those changes and work to take them into account. Now, we do a lot of work in the Philadelphia district on economic mobility, and community banks have been absolutely central to our impact. Given how much is tied up in their success, I think it's incumbent on us as regulators to be supportive of community banks' continued viability. We are well aware of the regulatory burdens that community banks have faced. I think that humanity overall has a propensity to overcorrect in response to a crisis. So the pendulum sometimes swings a bit too far in the other direction. In the aftermath of the financial crisis, it makes sense. It made sense to put every mechanism in place to prevent a recurrence of the worst economic disaster since the Great Depression. But there's virtually universal agreement that community banks wound up on the wrong side of that pendulum swing. We've made progress in correcting that, including easing up on timelines and reporting requirements, but I still think there's more to do. For me, a crucial element is how we work with banks. It's important that we're able to fix errors by working together, rather than at odds, to distinguish mistakes from bad faith. It's also critical that we continue to provide research and support. At the Philadelphia Fed, we've been looking at succession planning in particular, and our LINK program helps build relationships between community banks and community development organizations. Because community banks play such a vital role in the vibrancy of local communities, it's important that their business strategies take that impact into account, particularly for groups on the margin. And from a regulatory side, it's important to make space for efforts that might involve more risk, but also have the potential for much greater reward. So for example, we have a bank in our district, ESSA Bank and Trust, that partnered with an existing program to ease ex-offenders' transitions back into the community. They set aside $250,000 to make loans of up to $15,000 per person for things like housing, transportation, education, and training. The participants have to take a financial literacy course and provide a plan for what they're going to do with that loan. One needed a car, for example, to get to work. One trained to become a commercial truck driver. One used a loan to start a small business. So far, things have gone quite well with this program. But I would argue, even if they did lose money, there's more to consider. This bank, ESSA, is investing in their community in an important way that's often overlooked and generally underfunded. It has the potential for a significant return on investment for the community, and it creates a new customer base for the bank. Now, I think there's room for flexibility and a little more risk appetite to encourage such innovation. So to sum up, community banks clearly are important. They play vital roles in communities across the country, and they make the difference between a local economy that merely survives and one that thrives. They offer insight to policymakers and a chance for success to their customers. Now look, there are challenges, as there are in any industry. We've moved the needle on some, while others still have a long way to go. It's important that we work together as we address them, because the outcomes will have effects that resonate beyond the single sector, beyond the single bank. They're vitally important to the community, and when you add all that up, they're vitally important to the nation. So thank you, and let me take some questions if you have them.
All right. Any questions for President Harker? Yes.
Thanks very much, Pat. Very nice speech. I really enjoyed it. I want to ask you a question. I hope I don't stump you on. I hope you know the answer because I don't. So you mentioned financial technology companies and peer-to-peer lending, fintech, and so forth. This is something that community banks don't have the economies of scale or expertise to deal with themselves. My question is, but they have to deal with it. They have to offer mobile banking services.
Yeah.
They have to offer these other products. My question is, what is the best way to do it? One option would be, and this was discussed a lot by Yelena McWilliams yesterday, is partnering with fintech firms. But I'm thinking maybe there's a better way. Maybe there's a way that community banks have done this for the last 100 years. When you come up upon a technology where you don't have the economy of scale, you partner with your correspondent bank, and the correspondent bank figures it out. Because I don't know how a community bank is supposed to know which fintech company to go with or so forth. Maybe the larger banks can help them out with that. What's your view on that? Which way is the best way to go?
So I'm with you, Alan. I don't know the answer to that exactly, and I don't think anybody does right now. But we're watching this natural experiment unfold, right? So this is happening in front of our eyes. People are looking at a variety of different mechanisms. Which one will win? I'm not sure there's going to be one winner, but I think there are a couple of options you mentioned. I think we need to step back and look at the overall landscape. As you said, it's not just economies of scale in terms of production capacity. It's economies of expertise, right? If I don't have enough expertise on dealing with these issues and dealing with these vendors, because again, as you all know, particularly the bankers in the room, just because you've outsourced it to a third party doesn't mean you've outsourced all the risk, right? I mean, you still have to take that into account. So that expertise is critical. So what are the options? I mean, one is, as you said, the correspondent bank. One you didn't mention, which we hear a lot from, for example, our CDAC members, our community banks, is the core processors and their role in all this. And if there's a frustration I hear repeatedly from the community banking sector, it's dealing with the core processors. One of our banks in our district forced their way onto Zelle after many attempts, right, to try to get onto Zelle. And at the end of that, they added up the costs of getting on Zelle, all the costs, both the tolling fees and everything all along the chain. It was almost $1 transaction. That's unsustainable. You can't do that. I mean, you just can't do that for my kids to share a $15 dinner bill, right? I mean, it's just not possible. So this one particular bank is actually looking at insourcing, again, their IT. They're of a sufficient scale where they can start to think about that. But there are a variety of models going on right now. There's clearly, whether it's a correspondent bank or you're at a sufficient scale where you can do it yourself, or there may be other entrants into this market. You would think that in such a situation, there'd be other entrants in the market that would start to bundle services and provide it in a different way. I don't know the answer to that, but I think this is one that I am keenly aware of and watching, because I think this is one of the key challenges for community banks, is how to do what you do really well and sort of get rid of the stuff that you need scale, right, to be able to be competitive. Many moons ago, I wrote an academic article with one of my old colleagues, Gerard Cachon, on exactly this question from a theoretical perspective. And not only, if you do this correctly, will you get the scale economies, but even absent scale economies, there's reasons to do this in terms of pricing and the ability to turn a profit. So there's lots of good reasons to think about this. How this all shakes out, I don't know. But I think it's something we at the Fed have to pay a lot of attention to. And in particular emphasis on the core processors. Because again, I want to emphasize that again. What I hear over and over again is, because it's very difficult to switch, obviously, from one core processor to the next. But that issue is of top of mind of every community banker I talk to right now.
Other questions?
I stunned you.
Yeah.
Yeah.
John?
Where do you see the Fed's role in real-time payments fitting into all of this?
So we've already made the commitment to Fed now. This is in train. We are starting this process, and it'll take several years to build. I think that's really important, right? So that's going. Now I'll reemphasize the disclaimer. These are my thoughts only, nobody else. I think that is very important. It's important for your industry. we need to do this. I also think we need to start spending some cycles, brain cycles, on what's coming next. You know, the proverbial where the puck is going. So I think real-time gross settlement, that's a necessary condition, but it's not going to be sufficient for the future. What's the future? I think we seriously have to consider a central bank digital stablecoin currency. I may be in the minority on that right now, but I think it's something that we're not going to do tomorrow, we're not going to do 5 years from now, but it is something we have to seriously start considering. One of our young economists, Daniel Sanchez, has a very interesting theoretical piece on this that he just recently published on the welfare effects of putting such a thing in place. In fact, we're having a small conference in the spring of academics who are going to come together and debate this issue. This is, and I emphasize debate. I think this is one where, frankly, I don't think we should be the first mover as a nation to do this. One of my favorite companies' names that never survived during the dot-com boom, but I still like the name, was called Trailing Edge Technology. And their byline was just behind the bleeding edge, right? And their pitch to companies was, look, no, don't be an idiot. Don't go out there and bleed to death. You know, let those fools figure it out, and then we'll follow right behind. Fast followers, the new buzzword. I think that probably applies to us, too, as a nation, in terms of a central bank digital currency. I think that's inevitable. And whether we get our hands around it or the private sector tries to create alternatives, I think it's better for us to start getting our hands around this now. So real-time gross settlement, on its way. It's going to happen. We're going to build Fed now. It's going to be available. But I'm looking at the next 5 years or after that, you know, what comes next. And I do think it's something around digital currency. Going once? Yes, Jim.
Pat, I enjoyed your remarks. You were talking about consolidation in the industry, and that's something we've thought about a lot here in the Midwest. We have a lot more community banks in the Midwest than we do on the coast.
Right.
So I would kind of view you as being maybe ahead of the trend from that point of view. So what do you think the end game is here? One view would be that, you know, you really consolidate a lot and go down to just a few banks, or another view would be that you get to some stable fraction of community banks and things stabilize at that level. So given your experience in the 3rd District, what do you think?
So my own sense, and again, it's just a sense. I don't have a lot of facts to back this up except what I'm experiencing, is we are going to see community banks get larger, and that's what we're seeing exactly in the data I just said. But also you're going to see de novo banks start to meet, like Bird in Hand, right? Meet a particular need of a particular community in a very effective way. The challenge is in the middle, right? If you're not sufficient scale, but you really don't have that unique value proposition for a particular community, then those are the banks that are typically being acquired that we're seeing, right? Because they just don't have that compelling story. So I think you'll see larger community banks. At the same time, you're going to see the emergence of more smaller niche players that are serving a particular community very well. And that's what we're starting to see play out in the Philadelphia district. And I think that is what you're going to see across the country. We have another bank in our community that serves, an Asian bank that serves the Chinese community and other communities in Philadelphia. Again, understands that community very well, can serve that community very well. I mean, those are the ones that are, while they're not going to be large in scale, they're very important to those communities. So I encourage, you know, the formation and the thinking of new alternative banks to serve particular needs. And I think you're going to see both happening. It's that group in the middle that isn't of sufficient scale that probably is challenged right now. Yes, Robin.
So following up with all the community banks that you've seen acquired in your district, have you seen communities that are now going unbanked?
Not really to a large extent, because if the communities that are going unbanked would primarily be in central PA. New Jersey is pretty well covered and pretty there are rural areas of New Jersey, but given the dense population of the state, not too much. Same with Delaware. Central PA, there may be some challenges, but not so much yet. Because what we've seen happen, and you've probably all experienced this, when larger regional banks go in and acquire, that's an opportunity for the community banks to come rushing in. What's the first thing you do? Go grab commercial loan officers, right? Just go grab as much talent as you can coming out of those banks that got acquired. And you're starting to see that, we're starting to see that happen. So what we're starting to see actually is the opposite, that as the large players have come in, the smaller community banks have actually been expanding into communities by being able to acquire the talent. And again, the most pressing talent they need are the commercial loan officers. And they've been pretty successful at that, I would say, generally.
Yeah.
So a common theme of this conference has been the role of technology in the future of community banking. I was wondering if you could give us your view on how community bank supervision would change as a result of this increased role of technology in the banking sector.
So that's one of the things I think we're trying to do at the Fed is use technology ourselves so we're less intrusive in the banks. Right? So we've expanded for banks that are in good standing, right? We've expanded the time of examinations. But also we're trying to use more technology so that we don't have to spend as much time physically in an institution. Because we recognize that when we come in or your state regulator comes in, we're disruptive to your business. We try not to be, but we are, just by the nature of showing up. I mean, that's human nature. So the less time we can spend there, the more we can do offline with analytics, the better. So I think from our own perspective, that's an important issue. Second issue, though, is then with respect to the banks themselves, looking at things like your cybersecurity protections. And this is where, again, I go back to the vendors that you're dealing with. Because most of you, unless you're of sufficient scale, you're not providing those services yourself. You're buying them, right, from somebody, a vendor. And so I think one of the areas that I am very focused on is how do we address those vendors in a more systematic way so that you can get some assurance that what they're doing is best practice, right? And because often you don't have that expertise, right, to know. You try, but trying to create ways where you get more assurance, I think personally would help community banks a lot. To try, not to take you off the hook. I mean, ultimately, you are on the hook for dealing with the risk of outsourcing. But if we can find ways of easing some of that, or getting more information, more transparency, I would say, into the vendors that you're dealing with. And ultimately, in terms of market structure, this goes back to Alan's question, more fluidity in those markets themselves so that you have more comfort that what you're buying is safe and secure. That would be helpful. How to do that exactly, this is a work in progress. But I think those are the kind of things we need to focus on because it's not just regulatory burden. I mean, that's a real burden to banks. And so are there ways that we can help in that as opposed to get in the way of that?
Very good. Yes, and back.
My name is Jerry. I'm a PhD student from University of South Carolina. My question is, the greater use of technology, the greater operational risk, and the greater operational risk is kind of a threat to the financial system. How do you view this connection between the technology and eventually the threat to the financial system overall? Thank you.
That's an interesting, first, start with the hypothesis that technology alone creates greater operational risk than exists today. One could argue the opposite, right? That a lot of manual processes that, you know, the proverbial spreadsheet that's on the side that nobody knows about, except the auditors come in and say, what is that, right? And we've all experienced that. That creates operational risk too, right? So there's operational risk on both sides. That said, there are clearly certain risks with over-reliance on technology. Probably the largest one that's looming out there is cybersecurity, right? I mean, that is probably the granddaddy of them all. Because in the rest of the world, if I can create processes that are streamlined, that are well documented, and not have that spreadsheet on the side, I can reduce some risk. There, the cybersecurity risk is not going away. And I just want to leave you with one message. We have been starting a partnership in the system, led out of the Philly Bank, working with people at a very early stage on the emergence of quantum computing. And the National Institute of Standards and Technology have been taking the lead in this, along with others. There's a message from NIST I would like to give you, because you are worried about cybersecurity. If you read last week's Economist magazine, there was an article on the fact that Google just achieved quantum supremacy, which quantum people, quantum geeks hate that word, but what it means is Google's built a quantum computer that solved a problem would take the best supercomputer we have in the world right now, 10,000 years to solve. That's quantum supremacy. Quantum computing is coming. This is the message I want to give you, and this is directly from the people at NIST who are doing this. You're going to get vendors coming to you, telling you you need to buy our quantum-proof encryption algorithm right now. Don't buy it, okay? Yes, they're coming, but they're not here yet. They're not here for a while. At some point, this will come into the industry. We want to be part of giving you the advice about what this means, but it's not even close to being real. They are already seeing vendors in certain industries who are out there basically, to be blunt, scamming companies, saying you need to buy our quantum-proof encryption algorithm now or you're going to be in trouble. They're coming at you. They may not come today, they may not come tomorrow, but they're coming at you. Our hope is at the system level and with our fellow federal regulators, start to communicate this along with institutions like NIST of what you need to do or not do. And right now I'm telling you, you don't need these things. But the cyber threats are going away and they're going to change. I mean, things like, quantum computers are specifically designed to solve hard combinatorial problems. One of those is encryption. And so you will have to change over time, but not today. So you can sleep well tonight.
All right, I think we have time for one more question.
Yes. Brett.
Curious, we have a unique system in the United States for financial services and banking. It's also uniquely complex. I'm curious if you could make one change to the regulatory structure for financial services overall, what would it be? And also, if you could make one change to the Fed structure, what would it be?
Whoa.
Be on the spot.
No, so in the Fed structure, not a lot. I mean, we are this uniquely American institution, a decentralized central bank. Nobody else has this. But I actually think it's our advantage. I mean, I think it's a real advantage that the local knowledge that Jim brings to the meetings from this district or Mary Daly brings from San Francisco, we see very different economies. I mean, we see even within our districts, we see good, bad economies. So I think that piecing those things together, as opposed to all being inside the Beltway, is a really healthy thing. So that part, now you can say, well, we should change the geographic boundaries, yeah, reopening the act, I wouldn't. I just think that's not in the cards anytime soon. In terms of regulatory structure, I am not the czar of regulation. I want to make this very clear. But again, I want to go back to my earlier comments. I think it's no one thing, but I think there's a set of things we can do that would make community banks more successful. Some of that is relieving regulatory burden, but I want to go back to my earlier comments. But if there are other things we can do with other players in the industry that are providing financial services, support services to the community banking industry, if there's a way for us to enhance the competition in that industry and just make lives easier for community banks, that would be a helpful thing. The last piece of that, I would say that it's completely outside the regulatory structure. So if I talk to community banks, or what are the things that they're really focused on? We just talked about those. The other one is succession planning that I briefly highlighted in my remarks. I hear this from my community banks all the time. Are there ways for us to work with state regulators, state institutions, to bring more people into a career in banking and into community banks? Because what we're hearing right now is the community banks are just saying, I can't get the people I need. So one of the reasons they're offering their firm up, say, for acquisition, is they're saying, I don't have anybody to follow me. I don't have the bench that I need to have the strength I need in the bank. This is why things like we just had with the students, who I snuck in last night. I got in time to listen to the students. Listen to those students who are up in front here. None of them thought about a career in banking, to my knowledge, right? None of them. That's a problem, right? In that, we need to get more students thinking about this. And what was interesting is the comments they said, I never knew community banks were that important to our communities, right? So we need to also find a way of increasing the pipeline and working together with institutions that are all represented here in this room and around the country, and getting more talent into the industry. Because what you know is if you don't have the talent in the industry will struggle, right? Because we're talking about technology and so forth. At the end of the day, this is a people business. Even technology I'm a technologist. Even technology is a people business, right? It's people building the technology. And so if you don't have the right people in place, you're not going to be successful. That is not a regulatory issue, but I think it's one of the big issues that the industry is facing right now that I think we can collectively start to move the needle on.
Great. Well, you have given us a lot to think about. I think the researchers, whether it was intended or not, now have a laundry list of ideas to think about, so thank you for that. And just to put my plug in, the next panel, which addresses technology, is perfectly timed. And then our practitioner panel, which is targeted towards liquidity, but I think, Alan, we're going to get in some of the technology and how this might unfold in that panel too. So thank you for setting that up for us. We really appreciate it. Let's go ahead and thank you.